Thank you for joining us for Daily Rates Live with the Mortgage Calculator. Fixed flip loans, those of you that may have caught our Burr training the other day, this is the integral purchase loan usually for the fixed flip transaction. This is a loan that then the investor will refinance out of when they're looking to fix and hold as opposed to fix and flip. This is a short-term bridge loan. All fixed flip loans, whether you're going to hold it or whether you're going to sell it, they still call it a fixed flip loan, just like they call a DSCR loan a DSCR loan, right? This is a short-term bridge loan, interest only, depending on the ROI, which is return on investment in the deal. You are able to even build in interest reserve. So in some cases, if there's a good profit in the deal, you may not even have to make any payment directly out of pocket. It can come directly from the flip. All of it can come directly from the flip. Most importantly for the investor, I call these fixed flip loans credit preservation or credit score preservation loans, basically, because the investor does not use his personal credit, like credit cards, for example, to renovate the property, because if they have the intention on keeping the property and refinancing into a DSCR loan, they definitely need to have that credit score in good shape. And you know what happens when you run up those credit card balances is you lower the scores. So definitely investors out there, the successful ones, use the fixed flip loans. And when you consider that for a highly experienced investor, with at least more than 10 or 15 flips in the last 3 years, they can even attain up to 90% loan to cost, which would mean they only have to give 10% down at the closing for the purchase, and then the rehab is financed at 100% of the rehab cost. That would be absolute best case scenario. So let's see the scenarios that I have for you today to see if how close our flipper gets to that 90% LTC unicorn. So in this scenario here, our investor has 10 plus flips in the last 3 years, and it's a fairly profitable flip. They are getting 87% loan to cost, only 12.5%, 12.5% down payment, and a rehab is funded at 100%. So let me show you the breakdown here. So we have $115,000 is our purchase price. Since we are getting 87.5% loan to cost, we are at 12.5% down payment, or 14,375. And this is the fixed flip loan analysis. Here we have 30.49 ROI, right? $210,000 is our ARV. And here's where you can see the loan to cost and the ARV LTV, right? And here's our flip details. We had 115,000 as is value, 115,000 purchase price, 26,000 in rehab, and this was our interest and our discount total cost. So that's how the numbers get calculated, and the end result, since it is a profitable flip, is what you see here: the nice low interest rate, low cost on that rate, and high loan to cost. So this is our heavily experienced flipper gets a sweet deal. So now conversely here, so you can see the same scenario, the same ARV, the same rehab budget, purchase price, everything, credit score. The only thing that I changed in this scenario was that our investor now has only one flip in the last 3 years instead of 10 plus. And the difference is that the loan to cost is reduced to 80%. That means that our flipper has to give 20% down. Still a good ROI, hence they still get 80%, which is still very good. So $92,000 is the disbursement at closing, $23,000 is the down payment. and the rehab is financed at 100%. And there you see the ROI is still very good. The gross profit, all the numbers are good here. And he gets 10.74 with 1 point cost actually on that one. So let's go back now and look at another common scenario, the fix flip delayed finance refinance. Right now, our same flipper with 10 plus flips in the last 3 years experience. And this is where the individual purchases the property for cash and then is looking to refinance to get the money back that they put in, plus do the flip. So here our borrower gets $80,500 disbursement at closing, which is pretty cool because I had it set up that the purchase price was $80,000. That's what they paid for the property. And now he's going to get that initial money back. Plus, he's going to fund 100% of the rehab. So these are our numbers. Our loan to cost is 73.23, and our ARV LTV is 50.71. Right, so 10.24, and that is our information right there. So very good deal. He gets 10.24, and it's 1 point charge on that rate. So they get to recuperate the cash that they laid out, and they get the full 100% of the 26,000 rehab budget. That's the key here, folks. Right, you're getting 100% of the rehab. And in this particular scenario, he gets all of his cash money back. And our last scenario here is a fix flip refinance. This is where someone purchased the property with hard money or some type of financing. And in this case, again, I'm going with the $80,000 debt. And they want to refinance the debt, right? So it was purchased with debt, not cash, and then they want to also get rehab. And in this case, you're looking at 10.74 interest rate, and the borrower gets 69,000 out of the 80,000 that he owes. So the borrower is going to have to come up with some money at closing, $11,000, but they will get 100% of the rehab financed, right? So we can see the breakdown right here. Our ROI, our loan to cost of 65.47%. And this is our deal here. And our borrower paid, in this case, he paid 1.25 points, little riskier transaction. So you've seen here the 4 types of transactions typical for a fixed flip loan: the straight out purchase with heavy experience, the straight out purchase with light experience, the delayed refinance when they bought it cash and now they want to get their cash back and get the rehab, and the refinance of the existing loan that they purchased it with, so that now they can get renovation money instead of using their credit card. So great examples here, and awesome for all of our investors who we love to work with, because we love financing the purchase of the flip, and then we love financing the refinance when they exit out of the flip into the hold.